Tax Fam! If you are a shareholder of a company, you may receive payments known as dividends. These payments represent your share of the company's profits and are essentially your reward for investing in the business. Dividends may be a great way to boost your income and are often considered tax effective. So, how do dividends work? When you buy shares in a company, you're effectively buying a piece of that company, which means you're a part owner. As a shareholder, you're entitled to a share of the company's earnings, which come in a form of dividends. Dividends are distributions of something of value by a company to a shareholder. Under Australian law, a company's board of directors can authorize a dividend if they're satisfied that the company has sufficient net assets, can still pay creditors after the dividend payment, and is paying a dividend that is fair and reasonable. Generally, a company will pay dividends once or twice a year after announcing its mid-year and end of financial year results. For many investors, these payments form an important part of their investment strategy because dividends may increase their total investment returns by providing a regular source of income on top of the money they could make if their shares grow in value. Having said that though, no company is obliged to pay a dividend, and many investors are happy to buy shares in companies that don't, if they believe the profits can be put to better use. For example, a company may instead reinvest its money into the growing business with the goal of generating more earnings in the long term and subsequently increasing the value of the shares. But one of the most appealing aspects of investing in a company that pays dividends is that payouts frequently come with additional tax credits known as franking credits, and these credits are refundable for individual investors. I mentioned earlier that dividends are paid out of company profits. Now, these profits have already been subjected to company tax. So, in recognition that it would be unfair if shareholders were taxed again, the ATO offers shareholders a rebate for the tax paid by the company on profits distributed as dividends. These dividends are described as being franked. Franked dividends have a franking credit attached to them, which represents the amount of tax the company has already paid. So, when you receive a fully franked dividend, you're giving a credit for the 30% tax the company has already paid on the dividend. This credit can reduce the amount you have to pay on your dividend income by bringing it in line with your personal tax rate. If your personal tax rate is less than 30%, you can claim back some of the tax as a refund. Let's look at a simple example. You're an investor in Investco, who made a profit of $100,000 at the end of last financial year. They are a small business, so their company tax rate is 25%. This means that their total tax amounted to $25,000 and their profit after tax was $75,000. You hold 100% of the shares and opt to receive dividends on all the profits after tax. So, your franked dividend that you receive is $75,000. You receive this with a 25% franking credit, which isn't physically received, but which must be declared in the shareholder's tax return as income. This can then potentially be claimed as a tax refund. So, your franking credit amounts to $25,000, which means your personal taxable income is $100,000. According to your individual marginal tax rate, you are required to pay $22,967 on your $100,000 income declared on your tax return. But because you received the $25,000 franking credit, you'll actually be entitled to a refund of around $2,033. So, when it comes to franking credits, the basic rule is that the dividend is fully franked and your marginal tax rate is below the corporate tax rate for the paying company, either 30% for large companies or 25% for small companies. You can potentially receive some of the franking credits back as a refund or all of them back if your tax rate is 0%. If your marginal tax rate is higher than the company tax rate for the paying company, you could potentially need to pay additional tax on your dividend. You'll need to consider this when establishing your investment strategy and tax obligations. Now, we mentioned earlier that shareholders are given the opportunity to reinvest their dividends in additional shares in the paying company. If you decide to reinvest a dividend in this way, your income tax liability on the dividend is calculated exactly the same way as you would receive a cash dividend. That means you may have an income tax liability and no cash to settle it with because the cash was all reinvested. So you need to keep this in mind when you consider whether a dividend reinvestment plan is right for you. It's also worth noting that you need to make sure that you declare and submit your tax line number or TFN when you purchase shares, because if your TFN isn't provided, the company can withhold the top marginal tax before they send out the dividend to you, as they can't confirm whether you're an Australian tax resident or not. Dividends paid to non-resident recipients are subject to a flat withholding tax. So that's everything you need to consider when it comes to tax and investing in shares in a company. I hope this video answered all your questions. If it didn't, feel free to drop them in the comment section below. Otherwise, you need a hand with your taxes, you can speak to one of our tax accountants here at Box Advisory Services. We can also advise you on how to make the most of the dividends and create a strategy to help you achieve your goals. See you next time!